Is the world's largest economy heading for a recession? Recent economic indicators in the United States suggest that it might be. As analysts and market participants closely watch the Federal Reserve's actions, concerns are rising. With unemployment rates climbing to 4.3% and the Federal Reserve maintaining high benchmark borrowing costs, the signs are troubling. Economic momentum has slowed significantly, and some believe the U.S. could be facing a recession by early next year. The Sam Rule Recession Indicator, a historically reliable metric, has breached its threshold, signaling potential early stages of a recession. Coupled with a slowdown in job growth and increased labor force participation, the situation looks precarious. The question now is, can the Federal Reserve take timely and sufficient action to steer the economy away from a downturn, or is a recession inevitable? U.S. heading for a recession? Key indicators to watch. The state of the U.S. economy is a hot topic, with many analysts speculating that a recession might be on the horizon. Recent economic data points towards a potential downturn, raising questions about the Federal Reserve's next moves and the overall health of the economy. Unemployment on the rise. One of the most alarming signs is the rise in the unemployment rate, which recently climbed to 4.3%. This uptick has sparked concerns about a weakening labor market. The increase is primarily attributed to a higher labor force participation rate, meaning more people are either employed or actively seeking work. However, the slowdown in job growth is troubling, with July seeing only 114,000 new jobs compared to 179,000 in the previous month. This decline indicates that the U.S. economy might be losing steam. Federal Reserve's tight monetary policy. For the past year, the Federal Reserve has kept benchmark borrowing costs at a 23-year peak of 5.25%, 5.50%. While this tight monetary policy aims to control inflation, some analysts worry it might be pushing the economy towards a recession. The prolonged high rates could stifle economic growth, leading to reduced consumer spending and business investment. The Sam Rule Recession Indicator. The Sam Rule Recession Indicator, which has breached the 0.50 threshold, is a key metric that has historically signaled the early stages of a recession in the U.S. economy. This indicator measures the change in the unemployment rate over a 3-month average compared to its low during the previous 12 months. Its recent breach has heightened recession worries, although some experts argue it might not be a sufficient condition for a recession on its own. Bloomberg rate strategist Simon White notes that the market might be prematurely anticipating a recession, suggesting it might not occur before next year at the earliest. He points out that while the Sam Rule's trigger is concerning, it often lags and misses many equity downturns. Economic momentum and rate cuts. Brian Jacobson, chief economist at Annex Wealth Management, warns that the Fed might be on the verge of turning a win into a loss. The current economic momentum has slowed to the point where a rate cut in September might not be sufficient to stave off a recession. Jacobson suggests that a more substantial reduction than the typical quarter percentage point cut might be necessary to prevent an economic downturn. Mixed economic data. The recent jobs report has led officials to reconsider whether their policies are excessively cooling the labor market. The employment data revealed a significant slowdown in job growth, which has sparked worries about the U.S. economy's trajectory. This mixed economic data complicates the Federal Reserve's decision-making process, as they balance the need to control inflation with the risk of triggering a recession. Looking ahead. As the Federal Reserve prepares for its September meeting, significant data will be crucial in shaping its next steps. An acceleration in employment trends in August could strengthen the case for a rate cut. However, the consensus currently leans towards a 25 basis point reduction. Analysts and market participants will be closely watching the Fed's public communications next week for any hints about its future actions. The U.S. economy is at a critical juncture, with recession concerns capturing the attention of market participants and policymakers alike. The Federal Reserve's decisions in the coming months will play a crucial role in determining whether the economy can avoid a downturn or if a recession is inevitable. The U.S. economy's current state is a complex mix of rising unemployment, tight monetary policy, and mixed economic data. While some indicators suggest a potential recession, others provide a more nuanced view. The Federal Reserve's actions in the coming months will be critical in shaping the economy's trajectory. As we navigate these uncertain times, it's essential to ask, can the Federal Reserve steer the economy away from a downturn, or are we on the brink of a recession? Share your thoughts and insights on this pressing issue.